Hi there, welcome to Grain TV. I'm Kevin McNew. It's Thursday, August 18th, another mixed day in the markets. Let's take a look at GrainEdge's trading platform and see where we closed. In Chicago, corn managed to continue its inch higher, gaining 2 3/4, with front month September up to 333 and new crop D's up in the 340 range. Soybeans having a wild ride, as much as 17 cents down at one point, but managed to close only down 1 3/4 after falling below $10 a bushel on November delivery. And Chicago wheat continuing to be choppy, gaining 1.5 cents. News today was pretty light in the ag space. There was some action over in other markets, though. The U.S. dollar continues to erode, reaching its lowest level since early June, and that has helped fuel the crude oil rally. We had positive news in crude oil on Wednesday as EIA gave us a lower than expected inventory number, and that sent the market higher. And today's move in the dollar continued to accelerate crude oil, with crude oil up $1.50 on the close. So that was good news overall for commodities and may have helped some sense soybeans bounce back, because certainly soybean oil had a wild ride as too. It managed to close on the highs of the day. News today from USDA came in the center of export sales, their weekly report released on Thursday mornings, and we saw very little bullish numbers like we did last week. Last week we saw a round of really strong numbers from USDA, but this week was more tame, everything falling within analyst expectations. The only thing that fell outside of that realm was old crop corn, coming in at only 167,000 metric tons versus 250 to 450 expected. Both new crop corn and bean sales exceeded 1 million metric tons. That was supportive, although within analyst expectations, and certainly soybeans was a little light compared to what some of the high-end range was expecting. But nonetheless, for this time of year, still a very good number. And one of the things that is helping, especially corn, is the competitive situation we're seeing in the world market. If we look at the world landscape for corn prices right now, Argentina has taken a back seat to the U.S. because of the situation in Brazil. Brazil is short of corn, and so Argentina has become the favorite trading partner for Brazil to satisfy that shortfall. So Argentina's price is well off the board in terms of competition in the world market. So the really only other significant player we have to worry about at this juncture is the Ukraine, or the Black Sea market. And what we're seeing is a continual erosion in U.S. prices relative to Ukrainian prices. What I have here on this chart is the spread between Ukraine's FOB price and the U.S. FOB price at the Gulf. And if we look at a year-long spread of that series, then what we see going back to August of last year, that the U.S. price was at a significant premium to the Ukrainian price, especially around our harvest time last year. That really was driving our poor export situation. We were in such a competitive disadvantage in the world market, and especially as measured against Ukraine. I don't have it here, but if we looked at Argentinian's price, it would be a similar animal. Everyone was cheaper relative to the U.S. Most of that was the strength in the U.S. dollar. Now, as we move forward in the year, and we get to the later part of where we're at today, what we can see is that spread has favored now the U.S., with the U.S. price actually being at a discount to the Ukrainian price, and that really started to take shape in about May. And what you can see when we look at our export situation in the U.S., you can see a dramatic impact on our weekly sales. So go back to August, and what you can see is our exports in August, which again are a slow time of the year, but we're generally only around 500,000 combined old crop, new crop. But when we get into May, again, as that spread starts to change, the U.S. dollar starts to weaken and give us a more favorable spread competitive position, we see our export situation improve substantially starting in May. And even here in August, again, normally a slow time of the year, but we're doing consistently above 1 million metric tons of combined old crop, new crop deals, compared to same time period last year, where we were barely managing to do about 500 to 700,000 metric tons. So while we are still struggling as a market with oversupply, the good news is the competitive situation is likely changing and helping us as we move into new crop pricing as we get into harvest. So, while maybe not the huge bull stimulus some farmers would like to see at this juncture, it certainly is supportive of keeping the prices out of the doldrums, because we are in a very favorable situation from a world standpoint. Turning now to the technical situation, we've been following new crop November beans and new crop December corn here, and looking at some upside resistance here. Today, like I said, soybeans had a wild ride, trading below $10 on those beans, but managing to close around that 10.15 mark. We're still looking for 10.23 as upside resistance here. And in D's corn, we managed to break the 340 barrier, but we're still looking for 346, and today's settle around 343. So that's what we've got. Looking ahead to next week. Next week we have the Pro Farmer Crop Tour, and I think this is going to take on added significance this year because everyone is so skeptical about USDA's corn number at 175. So that Pro Farmer Crop Tour starting on Monday should prove to be important for the market, because it'll be some on the ground observations of what this crop may potentially turn out to be. And right now everyone's sort of skeptical of 175, but no one really has a good handle on what the true number might be. So stay tuned for us. Next week we'll be reporting on that Pro Farmer Crop Tour. As always, if you have questions or want to learn more about how you can become a GrainHedge trading client, visit us online at grainhedge.com and take a free demo of our trading platform. As a GrainHedge trading client, you'll get our technical alerts email first thing every trading day. Technical Alerts is a powerful system that generates quality trading opportunities. Each trading opportunity shows a chart and analysis providing clear price targets and risk potential. Technical Alerts look at historical chart formations and compare the current environment to the past to form concrete trading recommendations. The commodities covered by Technical Alerts includes grains, livestock, crude oil, currencies, bonds, and metals. Start your trading day with the most powerful insight into market direction and improve your trading today. Sign up at grainhedge.com to become a client.